Picture two massive, identical enterprise real estate brokerages operating side by side in the exact same highly competitive market, seemingly perfect from the outside. Looking at the top-line numbers, their performance is indistinguishable. Both firms have generated exactly $1.5 million in historical EBITDA. Yet, when these firms go to market, their outcomes diverge. The first brokerage receives a purchase offer of $10.5 million. The second is offered only $8.25 million. A $2.25 million gap for identical businesses requires an explanation. What drives this massive discrepancy at the negotiation table? During a capital event, acquiring firms and private equity do not actually purchase historical earnings. They purchase confidence. A buyer is paying for the certainty that those historical earnings are durable and will scale into the future. But that hard-earned confidence quickly evaporates when a multi-entity brokerage relies on manual, spreadsheet-dependent financial reporting in the back office. When consolidating entities or tracking variances requires manual workarounds, the business becomes exponentially harder to verify during due diligence. Buyers penalize this uncertainty mathematically. They apply a downward adjustment to the valuation multiple, a mechanism known as multiple compression. Long before negotiations even begin, a brokerage's back-office data architecture acts as a hidden discount, rigidly capping its ultimate enterprise value. Recent industry research sourced from the deepdive.tech for AccountTECH analyzes the precise impact of these valuation multiples in real estate brokerage M&A. The data establishes a clear baseline for brokerages exhibiting what analysts call strong reporting maturity. Strong reporting maturity commands a 7.0x multiple, yielding a $10.5 million value. The same EBITDA with spreadsheet dependency drops to a 5.5x multiple, yielding $8.25 million. This multiple-driven gap means spreadsheets cost the seller $2.25 million in lost equity. A 1.5x drop in a valuation multiple is not a random negotiation tactic. It is a highly specific, calculated penalty for financial uncertainty applied by the buyer. Structural damage to valuation intensifies during the due diligence phase, right after a letter of intent is signed. Data from EY Parthenon identifies a series of hidden costs that erode the purchase price. The first is the cleanup tax. This waterfall chart tracks the erosion. Buyers will not absorb the cost of stabilizing your finances. They demand explicit escrows and holdbacks to cover the post-close cost of rationalizing your charts of accounts and cleaning up manual accounting entries. The Institute for Mergers, Acquisitions, and Alliances points to a second major penalty: diligence fatigue. When reporting is fragile and person-dependent, answering complex audit queries takes days or weeks instead of minutes. Time kills deals. Protracted diligence windows exhaust the momentum of the transaction and shift negotiation leverage entirely to the buyer. The buyer uses this newly acquired leverage to execute a post-LOI retrade, demanding a further reduction to the final purchase price. Relying on manual spreadsheets hands the acquiring firm the exact leverage they need to systematically dismantle your initial offer price. These penalties materialize at the exit, but the financial damage actually accumulates daily, long before a sale process is even initiated. Research from Forrester Consulting tracks this ongoing manual administrative drag, a phenomenon termed EBITDA leakage. The culprits are routine back-office tasks, exception chasing, duplicate data entry across disparate systems, and endless manual reconciliations. This formula illustrates the primary mechanical effect. Bloated labor costs directly shrink the brokerage's net margin, the secondary effect compounding the damage. This artificially lowered net margin becomes the new diminished baseline that is then subjected to the compressed multiple. Because the reduced earnings are multiplied by a reduced valuation factor, the financial penalty of inefficiency is geometric, not linear. Manual back-office work acts as a devastating double tax. It quietly erodes your daily operating profits while simultaneously destroying your exit valuation. This valuation penalty applies acutely to multi-entity real estate organizations, which face a substantially higher risk profile than single-office firms. These organizations manage high transaction volumes across multiple locations, but their financial reporting maturity consistently fails to keep pace with operational complexity. The critical failure point lies in complex intercompany cash and expense flows. Routing capital across a parent company and its subsidiaries requires strict elimination logic to prevent double counting revenues or liabilities. Spreadsheets simply cannot reliably maintain these fragile connections at scale. Add complex commission plan requirements, and these disconnected systems buckle, producing systemic calculation errors. When a buyer reviews this architecture, they do not see a functioning back office. They see an unmanageable risk surface that requires impossible spreadsheet archaeology to audit. Securing a premium valuation requires automated, consolidated audit trails that allow a buyer to instantly drill down into the data by individual entity. As a multi-entity brokerage scales its geographic and operational footprint, a failure to concurrently scale its financial architecture converts aggressive growth into an unauditable liability. Evaluating the evidence from the due diligence phase confirms the core thesis of the AccountTECH report. Good accounting transcends basic operational efficiency. Modernizing a multi-entity back office is a critical, proactive maneuver to protect owner equity. This approach is an equity defense strategy. Executing this strategy requires systematically eliminating manual data touches across the organization to ensure auditors view the resulting financials as structurally durable. The mathematical stakes are definitive. Implementing this architecture is how you rescue the $2.25 million multiple-driven value gap identified in the baseline data. Achieving strong reporting maturity forces a confidence conversion in the mind of the acquiring firm or private equity analyst. By presenting a fully unified financial architecture, you mathematically nullify the buyer's leverage to demand escrows, holdbacks, and post-LOI retrates. For CFOs and brokerage owners preparing for impending mergers, acquisitions, or private investments, the directive is clear. You must bulletproof your earnings. The ultimate enterprise value of a brokerage rests on its ability to mathematically prove its earnings under maximum M&A scrutiny.